everybody this morning, and I'm joined this morning by Joel Aalbers, who's a partner and business advisor with MMP based out of Strathroy and Arkona. Joel's a CPA, CGA accountant, and he's been, aside from that, he's also been on the board of directors for Community Futures Middlesex since 2016. He's actually currently serving in the role on our executive as treasurer, and we've partnered with MMP quite a bit in the past around offering in-person workshops at various locations throughout Middlesex County. So they have been a great partner for us, and in particular for people, getting answers to difficult or complex questions around taxes, these types of things. And so I appreciate Joel taking the time today to participate in this webinar. And welcome, Joel. And I'm going to hand over the presentation to Joel. If you have any questions, again, raise your hand, use the chat function, and we'll be happy to accommodate throughout. So thanks, Joel.
Sure. Yeah, no problem. This kind of started out, we did it, I don't know if it was a year or 2 years ago. It seems like it might as well have been a decade ago, but we could actually do things in person. But this was originally like I think a 2 or 3 hour presentation that we did at the CFDC, but we've kind of trimmed it so that it's a little bit more time efficient. So I know, and everyone can still see my screen, correct? Okay, all right. So Todd's already kind of introduced me. I know what we used to do when everyone was sitting at tables was we could kind of just go down the rows and everyone could kind of introduce themselves and say what type of business they are. I don't know if you maybe just want to punch some information in the chat just so we kind of have an idea, but I don't think I'm going to go down and say, okay, everyone come on camera and introduce yourself. That might be a bit chaotic. So,
That's right.
So I guess just kind of, let's see, I don't know how to, because I'm screen sharing, I don't know if I can see the chat. Let's see if I can see it. Well, Todd, you might have to relay me if anything is put in the chat that's a question.
Yeah, I'll monitor that for you, Joel. Okay. So I think just push along. So if there is a question that you have, just put it in there and we'll continue, we'll definitely address it, yeah.
All right, so here's just the waiver that you're all signing. This is just, we're just kind of, looking at things at a high level, and it's not like you can hold me legally responsible for any of the things that I'm saying today. So, so these are kind of the things that we're going to be looking at, and I have my screen over here. So if I'm looking off camera, that's kind of why. So we just kind of have the topics that we're going to look at today. A lot of them are just kind of things that you're going to see as a business owner every year. Though we do have one slide that's just going to kind of talk about COVID-19 programs that are currently out there and ones that you may be interested in applying for as a business owner. So the first question is then, when should we be thinking of taxes? And as a business owner, the answer to that question is all the time. Pretty much any type of major impact, major life event that you have has some kind of ramification on either your business return or your personal income tax return. The kind of some of the things we're listing here are, obviously if your marital status changes, that changes a whole bunch of things on your tax return. If you move for a new job, that creates a whole bunch of deductible expenses. So basically, if you've got some kind of major change going on, it never hurts to ask your accountant, hey, this just happened to me. Does this have any impact on my tax return? I just had someone today say, I bought my first house in 2020. Is there anything that you need for that? And I said, well, there's a whole bunch of credits you might be eligible for. And there might be some other things that we need to look into as well. So the Income Tax Act is thick. There are a lot of rules in there, and chances are you don't know all of them. So it never hurts to ask. The other thing is people often, and I fall into that boat too, everyone always likes to have that big refund at the end of the year when they file their personal income tax return. The thing with that is it basically means that you've just given the government an interest-free loan for the entire year. So the ideal situation is when you file your income tax return, you owe nothing or even owe a little bit. because that means you haven't given the government any more than you need to. The other thing to also consider, though, is that if you do owe, it's always good as soon as, so if you're self-employed, because I'm going to assume most people here are self-employed, your filing deadline is June 15th, but they will start charging you interest on any balances owing as of April 30th. So you do have a longer window to file, but they will start charging you interest as of April 30th. So it's always something to keep in mind, because if you have a big balance owing and you file at June 15th, but you don't pay until June 15th, they'll charge you interest from April 30th to June 15th. So that's just something to keep in mind. Now, there is a difference here between tax avoidance and tax evasion. When you come to your accountant, you're looking for tax avoidance because that's legal. Tax evasion is not. So if you're coming to me and saying, I bought a pool and I'd like to somehow figure out how I can write my pool off in my business, that would probably be considered tax evasion and something that your accountant would be saying, this is not a good idea. So just to kind of clarify the difference between the two. So what our goal is basically, there's two things that most business owners need to kind of look at. It's how much am I paying in taxes and how is this impacting my cash flow? Because I often talk with clients and they're so wrapped up in minimizing their income taxes that they're spending $10 to save $1. Maybe at some point it just makes sense to pay the $1 in tax, right? And keep the extra money in your pocket to help cash flow other operations in your business. And we can kind of get into some of those examples as we get further on in the presentation. The other thing too to always consider is how organized you are when it comes to filing your income tax returns. Accountants are like lawyers, they charge by the hour. So if you show up, on June 14th with all your receipts shoved in a shoebox and say, here's all my stuff, please file my income tax return, that's probably going to create a higher cost for you than if you come in with a nice Excel spreadsheet with everything categorized already. So the more stuff you can do yourself, the cheaper your tax filing costs are going to be. So a lot of the questions I'm probably like, when we looked at the questions that came from people, a lot of them was, how do I reduce my taxes? And the short answer is, I guess, if you're paying taxes, that doesn't necessarily, that means you're making money, right? If you're never paying taxes, you probably have a bigger problem because it means how long will your business be able to float if you're losing money from year over year. Now, when you start a business, those first couple of years, chances are most businesses run at a loss for those first couple of years. But if you're hitting year 4, year 5, year 6, and you're still running at a loss, then how much you're going to owe in taxes is probably not going to be your biggest concern at that point in time, right? So we'll kind of now get into, I guess, kind of 10 issues that I think we see on a lot of personal income tax returns and business returns. Because if you're self-employed, your business income is being reported on your personal income tax return. It's just a separate schedule on your personal income tax return. If you're incorporated, then you're filing an entirely separate return, but we can kind of get into that later. So one of the first things is, if you are registered for HST, what will often happen is people aren't including the HST that they're paying on their home office expenses or maybe use of their vehicle for their business. So let's say you have your home office, you could therefore claim part of your utilities, property taxes, things like that. But that also means then you can take a percentage, whatever. So you wouldn't want to write off 100% of your utilities because obviously you're not using 100% of your house for your business. So let's say you're doing 10%. You could also then claim 10% of the HST. And you always want, if your choice is expensing something, expensing the HST, or claiming the HST on your HST return, it's always better to claim it on the HST return, because you're getting, for every dollar you spend, you're getting $1 back. If you're just expensing it, you're getting 30 cents on the dollar. So the more HST you can put on your HST returns, the more money you're going to get in your pocket when you file that return. The other thing is, assets that are being used in the business are not always being recorded and depreciated. So let's say you're running some kind of repair business and you have a shop on your property. Well, if you're using that shop for business purposes, you can write off the expenses related to that shop and write that off in your income tax return. So if you have repairs on the shop, if you have electricity running out to the shop, you can write that off. Just because it's, let's say, is on your personal property does not necessarily mean that there aren't expenses related to that you could write off. Basically, the rule of thumb is if you're incurring an expense to earn income, then there's a very strong possibility that that expense is deductible. So that's kind of what I always tell my clients when they come in and say, can I claim this? And I'll say, well, did you spend it because you were it was part of your business? And if the answer is yes, then you can probably write that off. Now, there's certain things, if like something like meals, you can only write off 50% because CRA says half of that is personal, but it's better than nothing, right? The next one is payroll not being tracked correctly or source deductions being remitted incorrectly. CRA does have a website where you can kind of use to calculate source deductions for your employees. But the other thing too is, so let's say you own your business and one of your children or your spouse is working for you. You do not need to deduct EI on their wages. And the amount of times I see people deducting EI off a wage paid to a relative, like in your family, I see that happen a lot. The reasoning why you don't have to do it is because if you were to ever lay that person off, they're not going to let that person collect EI, because else everyone would hire all their kids and then for the summer and then lay them off while they're back in school and try and collect EI. So if you have a spouse or a kid on the payroll right now and you're deducting EI, I'd recommend you look into getting that fixed. The other thing is that if you are, paying someone, you have until the 15th of the following month to get those source deductions paid. If you are late, they will charge you interest and penalties. And they can also charge you penalties if you do not file. And I will have some clients, when it comes to HST or payroll, they'll sit there and say, well, I don't have the money to pay this HST return, so I'm just not going to file it, because then CRA won't know how much I owe. The issue with that is the penalties for missing a deadline for filing are often more than the interest they would charge you for not paying. It is always better to file and then not pay than to not file and not pay. My experience has often been is if you file an HST return or even file an income tax return for that matter and don't have the resources to pay, if you call CRA up and say to them, look, I owe you $5,000. I can pay you $1,000 now and then start making installments of X amount over the next while, they will generally work with you to get that balance paid. The worst thing to do is do nothing and wait for CRA to come after you, because in the eyes of CRA, you are guilty until proven innocent, and they do have the ability to, if they can find where your bank account is, to just go in and take the money out. I've seen it happen. It's not good. So it's always better, if you're in that situation, to file your documents on time and then call CRA to make arrangements. So if you walk away with anything, that's one thing to keep in mind, because I have a ton of clients that figure they just don't file because they don't have the money, and that's always the wrong decision. Oh, well, number 4 was late filing of HST returns, and so I kind of just covered that. Now, you can kind of get into a similar issue with number 5, which is installments. Generally, if you owe more than $3,000 when you file your income tax return. CRA will require you to pay installments the following year. Either your accountant might give you a schedule for installments. CRA will also sometimes send you a calendar as well. Now, whether you make those installments or not is up to you, but they will charge you interest if you don't make the installments and then proceed to owe the following year. Now, the thing with installments is it's always based on what you owe the following year. So let's say you had a really great year and you owed like $20,000. Well, they're going to say that your installments for the following year are based on you owing $20,000 again. But you might sit there and say, well, that was a one-off. I'm going to only owe probably $5,000 the next year. So if you only make installments based on $5,000 and it turns out you only owe $5,000, they won't charge you any interest. The problem is let's say you think you're only going to make $5,000 and then it turns out you owe $50,000. Well, then they're going to charge you installments on the $20,000 that you did, or the difference between what you made and the $20,000 that they said you should have paid. Does that make sense? Okay. Poor record keeping, we've kind of already talked about that. For me, I always prefer to have too much information than not enough, because the more information I have, the more options I can provide to you. And it also means I'm probably going to bug you with a lot less questions. And for some of my clients, they'll be okay with one round of questions, but if I give them a second round, they start getting annoyed. So the more information I have, the better. Number 7 is combining personal and business expenses. Now, I know with some of my clients, they'll just come in and say, well, here's my total utilities for the year was $3,000. So then I'm going to have to come back to them and say, well, what percentage of that was a business expense? And they'll come back and say, well, the higher I push that percentage, the less I'm going to pay in tax. So I'll say 90%. My response to that is going to be, is that number reasonable? Because that is often what CRA will look at. Is the percentage that you're using reasonable? So, if you have a shop on your property and, you've got, equipment in there that you're using to manufacture something, then you know what? You can probably claim a higher percentage of your utilities. If all you have is a small office with a little desk in it and a lamp, if you try and claim 90% of your utilities, CRA will probably have a problem with that. And I have heard of one instance where the auditors came out with measuring tapes and measured the person's office to see if what they were claiming as a percentage of their house was accurate. I've heard of that once. I don't know what that person did to tick them off, but they came out with a measuring tape. So number 8, so not including all eligible expenses related to the business. This kind of goes back to, if the expense was incurred to earn income, then you can deduct that expense. So I'm not saying be super aggressive, because once again, it kind of gets into that reasonability section again. Not including all revenue generated by the business. So CRA has an issue if you barter. They do not like people barter. So if they find out you are bartering, they will say that should be reported in income, and you should also record the corresponding expense. There can also be, that's kind of one of the main ones. You can also kind of get into issues sometimes when people have multiple businesses. So let's say you have your main business and then you also have another little side gig that you're doing. CRA would say, well, all of this needs to be reported, unless it's like some kind of hobby and you're losing money all the time. If you're profitable, CRA wants that reported on your income tax return. And number 10 is getting advice from people that are not accountants. So your neighbor down the road may be a well-meaning person, but they may have no idea what they're talking about, and their situation may be entirely different from yours. I've had a number of occasions where people say, well, my neighbor did this, so how come I want to do the exact same thing? And once you sit down and look at their particular situation compared to what your particular situation is, what worked for them may not work for you. In fact, it may be a terrible idea for you. You can get into, I've had people that have just shown up in my office and say, well, I incorporated. And I said, well, why did you incorporate? Well, it seemed like the thing to do. The thing is that maybe they aren't making enough money to make incorporating worthwhile. And now they are stuck with this corporation. There are a lot of things in income taxes that are easy to set up that are terrible to tear apart. So when you want to jump into some kind of restructuring, bringing in a partner or something like that, it's always advisable to talk to an accountant first to find out what the long-term ramifications of what you are doing can have on your business. Especially, I've had some people that talk about, well, we've had a long-term employee and we really value them and we kind of want to bring them into ownership. Well, what are the ramifications of doing that? How easy is it to get them out of ownership if you start having a dispute a year or two down the road? So these are all things to consider. I wouldn't make any of those decisions flippantly. I would always make sure that you've kind of looked into the pros and cons, and especially what are the tax implications of what I'm about to do.
Joel, did you want to pause to see if there's any questions after that? Because it's sort of a segue into your next section.
Sure.
Is there any questions? I don't see any additional questions here. There was some feedback into participants, just to give you an idea. So we have seasonal retail, a home furnishings retail, and then another person that identified that they have a micro business, multiple different ventures or whatever that they're running personally, right, through their personal, not necessarily business basis.
Yeah. So. Yeah. So when I hear something like that, that might lead to HST issues, but I've got a slide that's kind of covering that down the road.
Okay.
So you can get into that then. But yeah, if anyone has a question and you just want to jump in and cut me off, I'm not going to be offended. So feel free to do so. So we kind of get into the personal income tax rates. The one thing to keep in mind here is just because you jumped from the first bracket, let's say, to the second bracket, doesn't mean that every dollar you made is now going to be taxed at that second bracket rate. It's only the dollars that fall into that next bracket that are going to get taxed at the higher rate. So the second bracket ends, I think the first bracket ends in the upper 40s, the second bracket ends in the mid 90s. So you have a lot of space before you're going to start jumping into that third bracket, which is what I kind of consider that now you're paying a higher rate of tax bracket. Yes, it's great if you're in the first. If you're in the second, it's not as good, but I'm not going to lose sleep over someone being in the second tax bracket because it's still, yes, you're paying taxes, but you're not paying a boatload of taxes, I guess would be the technical way of defining that. But once you kind of get close to those brackets, that's when you can kind of look into Rrsps. And for people that are self-employed, Rrsps is probably one of the better ways if you're looking at so let's say you're right on that edge of jumping into, let's say, the third tax bracket. So let's say you came to me and said, well, I think I'm going to profit $100,000 this year. Well, then I could say to you, well, if you make a $5,000 Rrsp contribution, you're not going to have any income in that third bracket, right? And if you're self-employed, the other thing to keep in mind too is, let's say you still got a wage from somebody else, right? So you could have a $50,000 wage, which your payroll people would have been taking income taxes on throughout the year. But if you then all of a sudden, let's say, have $20,000 in self-employed income, that all just gets tacked on top of that 50, and now it's all in the second bracket, and you haven't paid any income taxes on that until you file your return. So that could then lead you to owing a larger amount of tax because all of that $20,000 is going to get taxed at the second bracket, and no income has been withheld, or no taxes have been withheld throughout the year. Okay.
Got a question here for you, Joel. Just one second. What actions are required from an income tax perspective to close out a business?
Self-employed or incorporated?
It's a good question. Wait for a quick response from Doug. Incorporated.
Incorporated? So that is a little bit more complex if you want to shut down a corporation. Basically, in order for CRA to let you shut a corporation down, you have to be current on all of your corporate income tax returns. And then you send a letter to CRA saying that I wish to shut down this corporation. Generally, when you do that, you want to make sure that most of the liabilities have been paid off in the company and that you've kind of taken all the cash out so that there's a minimal amount of assets and liabilities left in the company. CRA then approves your company to be dissolved. And then you have to file one more tax return from the date from your last year end until the date of dissolution. So it's a bit of a process. It's harder to wind up a corporation than it would be if you were self-employed. If you're self-employed, you just stop, right? And like if you say this business isn't for me, you just stop. Now, if you have an HST number, you might get letters from CRA saying, hey, you haven't filed an HST return. Well, you just put all zeros if you didn't have any income that year. That would be the extent of it.
Yeah, I have a question follow up to that is if you have an HST account, so you close your business and you registered and had an active HST account, how do you go about closing that HST account if you close the business? Like, so you're not actively.
Right. It's just, I think at that point in time, you could just call CRA.
Okay. Yeah. Okay.
And say, now the only thing would be is if you bought capital assets in the business and claimed the HST on it and then shut the business down, you may have some HST complications because now you own an asset personally that you were treating as a business asset and claimed back and still claimed 100% of that HST.
Oh.
So if you own a building and you claimed that HST when you purchased the building and you are now thinking about shutting down your HST account, that could have some major implications because that could be considered a deemed sale by CRA and they could then make you pay HST on the value of the building when you shut down that HST number. So that's one of those things where it's good to talk to an accountant before you do it. That's one of those things where you say, I'm thinking about shutting my HST number. What are the ramifications of doing this? Because it could be nothing. It could be a headache.
Yeah. Okay. Well, thank you. Okay.
So then we kind of get into different types of income produced, different types of tax rates. So capital gain, so let's say you own a building, you sell that building. The difference between what you paid and what you earned is to consider the capital gain, and you would be paying taxes on half of that. So that is probably if there's any type of income that you can get, capital gains are probably the best because you're only paying tax on half. If you have a wage or interest, it's all just getting added to your income and you're going to pay taxes on the full amount. Dividends, so that kind of gets into if you're receiving dividends or if you have your own corporation and you're receiving dividend income from the company, that's paid from after-tax income. So you effectively receive a credit for the taxes that the corporation has already paid. So in the CRA's kind of planning on that is the way they look at it is between the company and the individual, the total taxes that are paid to CRA should be equal to if the person had earned that full amount as a wage. So I could get into a big long speech on dividends versus wages, but I'd only want to give that speech if I was dealing with 100% of you are incorporated, and that's probably not the case right now. Because I could probably take 15 minutes just talking about the pros and cons of dividends versus wages. So that's something, if you have a question on that later, shoot me an email or something like that, and I can give you my spiel on that. So the other thing too is when you're looking at your investments, this is one of those things where people can get so wrapped up in the tax side of things that they don't necessarily look at the bigger picture. So if you're getting close to retirement, or if you're just investing because you anticipate having to make a capital asset purchase down the road, it's probably better to be in less risky investments at that point in time. Yes, the return might not be as great, but the reason why that money is set aside is because you're intending to use it for something else. If you're 65, you don't want to be putting your money in Bitcoin or something like that, because you're close to retiring and you probably don't have the tolerance for the wild ride that Bitcoin's going to give you, right? So the closer you get to retirement, the safer you want to be. You can also kind of get into, should I pay down my mortgage or should I put money into an RRSP? The one thing that whenever I get that question is, well, what is the rate of return that you're going to get on that money that you put into your RRSP? So let's say you're super conservative and you're going to put it in a GIC and you're going to get an interest rate of under 1%. If your mortgage is 3, 4, 5, 6%, well, it's going to probably make more sense to pay down that mortgage, right? Because the interest rate is so much higher. What some people will do is they say, well, I'm not really concerned about the taxes. I kind of want to save for my retirement. So you put the money into the RRSP, get the refund, and then use the refund to either A, get more RRSPs, which you then deduct next year, or use the refund to pay down the mortgage. So you can kind of, because if you don't put any money into the RRSP at all, then you don't get the refund. So it's kind of way of multiplying the effect of the impact of having the RRSP. So it's just something to consider. The other thing is interest deductibility. So what can sometimes happen there is if you borrow money, there's only certain times that it's going to be deductible, right? It has to be for business purposes. So what I'll have sometimes that people do is they'll say, well, I want to borrow money for the business, but I can get, a 3% rate if I borrow against my house and just tack it onto my mortgage, or I might get a slightly higher interest rate if I get a commercial loan. The issue is if you tack it on your house mortgage, it becomes a lot harder to track it for tax purposes. Or if let's say you have a line of credit where some of the money you're taking out is for personal reasons, because you put in a pool in your backyard, and the other part of it is for business purposes. If you're constantly mixing personal and business cash coming out, let's say out of a line of credit, and CRA comes in and says, well, prove that this interest is deductible, and they just look at this account and see money going in, money going out, and sometimes it's paying for groceries and sometimes it's paying for supplies for the business, they might just come in and say, this is all personal, and we want you to, and until you can prove what's actually related to the business, we're just kicking it all out. So it's better, if you did a mortgage against your house, that's probably a little bit easier because we can say, okay, this 60,000 was related to the business. So, and then you do some kind of prorating calculation. But if you just got a line of credit and you're just flowing money all over the place and you don't really know what's personal and what's business, it's going to become a lot harder to prove what's deductible. And the same kind of goes for a bank account. I always tell my clients to get a business bank account. Do not be running your business through your personal bank account. And the issue with that is if you get audited by CRA and you're running your business through your personal bank account, CRA can come in and say, we are going to assume that every single deposit into this bank account is business income. So you might have it, maybe your grandma left you some money and you deposited that into your bank account. CRA will come in and say, we don't know if this is business income. We don't know if this is a personal deposit. And until you can prove that it's personal, we're treating it as business income. Here's the taxes that you owe. Here's the CPP that's owed on that because it's self-employed income. And the interest is running until you can prove us wrong. So it gets back into that you're guilty until proven innocent with CRA. And I realize I'm kind of maybe putting the fear of CRA into you. And I don't think every single CRA auditor is cruel, but they do have that authority on their side. So just be aware. Another question I get is, should I lease or should I buy? And I can give you the tax answer for that. So if you buy, so let's just do it as a vehicle because that's what I see the most often. If you buy it, so the depreciation rate on a truck, let's say, is 30%. Because of some new rules that they have recently, you're going to be able to write off 45% of that truck in the first year, and then 30% of the remaining balance every year after that. If you borrow money to buy the truck, the interest will be deductible as well because you bought it for a business purpose. This assumes you're actually using the truck for business purposes and not using it to ferry your kids back and forth to the arena with the hockey equipment in the back. CRA might have a problem with that. It's all, what I often will tell clients is, if you've got two vehicles and one is a Honda Civic and one is a pickup truck, if you ever get audited, you point at the truck and say, that's what I use for my work. And you point at the Civic and say, that's what I use for my groceries. If they show up and all you've got is one truck, they're going to turn to you and say, how are you getting your groceries? How are you bringing your kids to hockey? There's no way that this vehicle is 100% business. So, sorry, I went on a bit of a tangent there, but that's kind of how it works with buying. With leasing, the lease is 100% deductible. Now, the other thing to kind of look at it too is the HST. If you buy it, you're going to get all the HST you paid back right away. If you lease, you're only going to get it as you pay it on the lease. That is the tax side of things. The other side to look at when you're looking at buying versus lease is the cash flow side of things. So if you're the type of person that you buy a truck, you're going to run it into the ground, then buy it, right? If you're the type of person that needs a new vehicle every year or two because you just like having the newest technology, then maybe leasing makes sense just because you drive that vehicle off the lot. Or maybe trucks are a bad example because they seem to be paying a ton of money for used trucks these days and they ship them to the States. But you drive that vehicle off the lot, you've lost a couple $1,000 right there. So this is one of those situations where don't get so caught up in looking at the tax side of things that you miss the cash flow side of things. Tax-free savings account. So people will often say, what's better? Should I put money into an RRSP or should I put money into a TFSA? Generally, the thinking behind an RRSP is you put money in when you're in a higher tax bracket, and then you take it out when you retire and you're in a lower tax bracket. That therefore means if you are currently in the lowest tax bracket, if you put money into an RRSP, you would have paid money at the lowest bracket now. When you take it out at some point in the future, you're still paying money at the lowest rate in the future. So it may very well be that if you're in the lowest bracket, a TFSA makes more sense than an RRSP because any growth on that investment is tax-free. So as long as you're not day trading in your TFSA, because then CRA says you're potentially running a business out of your TFSA, it could be more beneficial if your income is low to put your money into a TFSA as opposed to an RRSP. Okay. Any questions? I realize I'm just throwing a ton of information at you, so. All right, I shall proceed. So this one kind of gets into, I think I've kind of already talked about this one, is good debt versus bad debt. So if you borrow money, so let's say invest or something like that, that interest is tax deductible. So if you're borrowing money because you're going to buy stocks, or you're borrowing money because you're going to invest in your business, or even your uncle's business or whatever that may be, that interest is deductible. So it's always good to kind of get your paperwork in order and your ducks in a row if you're going to borrow money, because that can be a sizable tax deduction, right? Because if your tax rate is 35%, for every $1,000 you spend in interest, you're going to save yourself $350. So it's worth looking into and making sure that you got your paperwork in order.
Joel, just a quick question. Someone's asking, which level do RRSPs make sense? So, I mean, I don't know if that's on income levels, probably, right?
Sure. So as soon as you go into the second bracket, that's when the RRSP starts making more sense. The higher the higher bracket you get into, the more sense it makes. So let's say you're in that top bracket and you're getting taxed at 50%, right? If you make an RRSP contribution and pull that money out when you're retired, and let's say you're now back into the lowest bracket and you're getting taxed anywhere around 15-20%, Well, you've just saved a lot of taxes. Now, mind you, you end up with, you know, if you're in that top bracket and you got $500,000 or something like that sitting in your RSPs by the time you retire, well, then maybe you're jumping into a higher bracket back then, you know, when you retire. So maybe you're kind of, at least you're kicking the can down the road, right? Yeah. Does that kind of answer the question?
I think so. I think there's a couple of follow on now too. So I guess related to that is how do you know what tax bracket you're in? I guess that's something you can just touch on, like how do you figure that out? And
yeah, because the problem is often you don't know what tax bracket you're in until you file your income tax return, right? But and then it's because you have till the end of February, you have the first 60 days. So if you were looking at making an RSP contribution, you've got like 3 days to make that decision. And you may not necessarily know what what tax bracket you're sitting in. And when you're self-employed, it becomes a little bit more difficult because you don't necessarily know where you're sitting because maybe you haven't sat down and crunched the numbers. But that then goes back to my point about, are you a spreadsheet kind of person or are you a shoebox kind of person? Because if you're a shoebox kind of person, you will have no idea. You might, if you're the type of person that looks at your bank account and says, there's money in my bank account, therefore things are going well, you won't know until your income tax return is filed, and by then it's too late. You don't have the ability to plan. Even if you're building a simple spreadsheet and you're sitting there going, okay, I know my revenue is this, the expenses that I have on hand are this. Yes, there's probably some expenses that my accountant is calculating that I'm not aware of, like depreciation or something like that. But at least then you have a good idea of where you sit. Because as I said, that first bracket is at around 49, I believe it is. I'd have to get that up in front of me because it changes every year. But, you know, if you have a wage of, let's say you're working part-time and you have a wage of $35,000 or something like that, it's not going to take much for your self-employed business to earn another 15, right? And now you're in the second bracket. And if you're the type of person that says, I'd rather have money in an RSP than pay taxes to the government, well, then maybe, you know, that's like, I have some clients that will come in and we'll do an estimate for them December, January, February. I've got one guy that doesn't want to pay a diamond tax. So every year he comes to me and he brings in all his slips in the middle of February and I give him a number. So it can be done, but you have to be organized. And if you're not organized, it becomes really tough to do so.
Yeah, I think that's good good response without sharing the kind of those tables and that type of thing. I think
you get lost in the weeds pretty quickly when you start getting into actual numbers.
Yeah, and so I guess just to quickly comment on one other thing, can you comment on the deductibility of credit card interest?
Oh, okay. So are you talking about credit card interest or credit card fees?
I think it's the interest.
The interest. So if you're paying interest on a credit card and that debt was incurred because you were buying, you know, it's for business expenses, it's deductible. Now, mind you, from a cash flow perspective, if you're sitting on credit card debt and you have the option to get a line of credit from the bank, get the line of credit and pay off the credit card debt, because the amount of money you will save on interest is substantial. Credit card debt is the worst debt to carry because you're paying something, what, I don't know, 20, 30%. It's crazy.
Yeah. Okay, well, that's good. Thanks.
Yep. Oh, so quickly on RRSPs, that's, if you got kids, I highly recommend you set that up. It's free money from the government. So I know it's tied to your income, but even I, as an accountant, wasn't paying attention to it at first. I didn't set my first one up until I think my oldest daughter was 2 or 3, and I'm kind of kicking myself for not setting that up earlier. So it's something to look in if you got young kids. Deductions versus credits. So a deduction is always generally going to be better than a credit. So an example of a deduction would be your RSP, because basically it comes right off the top of your income. So if you had 50 grand, you made a $5,000 RSP contribution, you're now paying taxes on 45,000. So it's saving you money at whatever marginal tax rate you're paying at. A credit is going to be something like medical or the age amount or something like that. And generally that's just it's calculated at the lowest rate. So a deduction is always better than a credit. That's kind of just so you kind of have an idea of the differences between the two. Will and estate planning. Now, I could probably give an entire presentation just on what happens when someone passes away and the tax implications of that. Just to give you the Coles Notes version is one, make sure your will is up to date. So if you haven't updated your will in like 10, 15 years, that's probably too long, especially if you have a business. Because if your will says something like, my corporation will be split evenly amongst my kids, that could be a very good way to tear that business apart once you pass away, because the kids will fight, especially if there is a ton of money in that corporation. The other thing to keep in mind is from the perspective of CRA, the last thing that you do before you pass away is sell everything that you own. So if you have an Rrsp, that comes into income. Unless you're married, you can pass it to your spouse. But so we'll just assume you're single. Your Rrsps will all come into income. Your Rrsps will all come into income. Any investments that you have will be considered to have been sold. So all those taxes come due on your final return. So that can often lead to situations where you need to plan ahead of time. Maybe you start taking money out a little bit faster so that you're not hit with this huge tax bill in the year that you pass away. Now, obviously, no one knows this. You don't necessarily know when you're going to die. So planning for that can be a little bit difficult, but there are steps you can take. So I think this is probably one question that a lot of self-employed people are going to ask is, when should I incorporate? There's basically two reasons that I will give to my clients for incorporate. The first is legal, and I'm not a lawyer, so I just give you a really quick answer on this one, is it gives you an added layer of protection. So if you're self-employed and you get sued, they can go after all the assets that you own. So that puts, if you have a cottage, that is at risk. If you are incorporated and something goes wrong, there's a slip and fall or something like that related to your business, they sue the corporation, any assets that you hold personally are protected. So there is a liability benefit to incorporating. Now, a lawyer is going to be able to give you a better answer on that than I would. The one that I can talk about is income tax. So the corporate tax rate on the first $500,000 in 2020 was 12.2%. There is no personal income tax bracket that is that low. So the tax savings are substantial. The thing with that is I often, when I'm talking with my clients about incorporating, I will say to them, I will let you know when I think it's time to incorporate, because the thing with that is once you set up, it's easy to set a corporation up. It's difficult to tear it apart. So what I'll often say to them is, how much money do you need to live on? Because if you came to me and said, well, my business made $60,000 profit last year, but you need $60,000 to live on, then there's no point in incorporating, because we could set that corporation up and you have $60,000 in profit. But if I got to pay you $60,000 in dividends or $60,000 in wages to cover your personal expenses, well, then the entire benefit of incorporating has just gone out the window. And all you've done is incurred a bunch of additional accounting fees and legal fees to set it up, and you're not receiving any of the benefit. So basically, it becomes, from a tax perspective, it becomes beneficial to set that corporation up. Well, there's two. If that corporation is making more money than you need to live on. So let's say your business is just taking off and is flying and it's making $150,000 a year profit, not revenue, profit, because it's profit that you get taxed on, not revenue. And you come to me and say, Joel, I only need 70. I can live on $70,000 a year. This extra 80,000, I'm just paying taxes on, and I don't need it. Then we set the corporation up. We can still pay you a $70,000 wage or whatever it may be. That extra 80,000 stays in the company and gets taxed at 12.2% instead of 40%, or whatever your personal income tax rate may be. that leaves you with more money on hand to pay down debt, to buy assets for your business, or to just hire people. It leaves you with more cash to grow the business. The other reason you might want to incorporate is if, let's say, you have a business asset and you borrowed a lot against it, and it's really hard to service that debt. If you have that in a corporation and you're taxed at 12.2%, it leaves you with more money in your pocket to pay down that debt. So that's kind of the pros and cons of incorporating. Is there any questions on that? I kind of covered this next slide already. What I would not, like, I had one client who was having trouble getting financing and he really wanted to buy a building. So the lawyer came to him and said, well, I think it's going to be easier to get financing if we just incorporate you and get the financing through that. So they went ahead and did it, set up the corporation, and then told me after the fact that they had incorporated. Well, I looked at their business and said, there was no reason from a tax perspective to incorporate. So just so you kind of have an idea, if you're self-employed, to get your personal income taxes filed, depending on the complexity, it could be $500, it could be $1,000, depending on how organized you are, how complex the business is. If you have a corporation, you're probably looking, if you came in with everything perfect, you're probably looking at a minimal cost of anywhere from $2,500 to $3,000 a year. So if you're saving, $30,000 in taxes a year, paying $2,500 a year to have a corporation it's worth it. It's a smart business decision. If your company's breaking even, now you're paying an accountant and a lawyer a couple $1,000s a year and you're getting none of the benefits. So always talk to an accountant before you incorporate. You will save yourself a ton of headaches by having a half-hour conversation.
So here's a question, Joel, related to this incorporation component, and I think your previous slide on 10 about so the question is, does the gross income, right, have to be 500,000 before considering incorporation? So it's kind of
no. So the reason I said 500,000 is once your profits go over 500,000, that tax rate jumps from 12.2 to 26.5. Still, it's still a low rate compared to, like, let's say, because if you were making $500,000 and reporting that on your personal income tax return, you're paying 50% tax because you're in the highest bracket. So it's still a favorable rate. It's just not as good.
Yeah.
Okay.
Good.
So we get into some other advantages here. We've talked about income tax savings. There is the income splitting. CRA has recently changed some rules that don't make it as good as it once was. You can achieve some of the same results by being self-employed, by paying wages and things like that. It is good for succession planning is another one that I didn't really touch on. Corporations have an indefinite lifespan, right? So if you start your business, it becomes successful, one of your kids gets involved with the business and you want to pass that business on to them. If you're incorporated, you can do that on a tax deferred basis and not trigger a whole bunch of income taxes, depending on how you want to transfer that to the next generation. It can become a bit harder if you're not incorporated and let's say you have assets and you want to sell them those assets, right? If you have a building or, let's say you're in the excavating business and you've got heavy equipment, stuff like that. So it's something to consider too when it comes to succession planning. So the other question is how do I lower my taxes? And another way to do that is by income splitting. And as I said earlier, there's good ways to income split and there's bad ways to income split. So let's say you're self-employed and your spouse or your kids is helping you out with your business. It is entirely legitimate to pay them a wage as long as that wage is reasonable. So if your kid helps you out for a couple hours a week and you turn around and pay them $50,000 a year, CRA is probably going to come in and say that's not reasonable. All you're doing here is pushing income from you that should have been taxed in your hands onto your kid. So, but if your kid is working 10 hours, 10 hours a week for you, and you feel you come up with a reasonable wage, that is a entirely legal way of transferring profits from you to your kid. And if the wage, you can make $12,000-$13,000 a year and not pay any income taxes on it. So if your kid has earned, legitimately earned a wage of $5,000 a year, pay them the $5,000. Now you have a $5,000 deduction in your business, and your kid now has $5,000 that they're not paying income taxes on. But it has to be reasonable. You can get into a world of pain if you are paying them an unreasonable wage and CRA catches you. So I think that kind of covers that. So the other thing here too is Rrsps. So if, let's say there's a husband and wife, the wife is making $150,000 a year and the husband is making 40. It makes perfect sense for the wife to make Rrsp contributions. It makes no sense for the husband because he's in a much lower bracket. You can contribute to a spousal Rrsp. So you use your Rrsp room, you put it into an Rrsp that's in the name of your spouse. It has to sit in there for 3 years. And then when that money gets taken out, it's taxed in the hands of the spouse. So that is another way that you can income split if one of you is in a higher tax bracket and the other one is in a lower. It also becomes a way to effectively tax plan, because let's say one of you has a really great government job with a gold-plated pension that the rest of us don't have. Then that person might have a substantial income once they retire. So the last thing they want to do is have Rrsp or RIF contributions coming out on top of that. So if they can get that into the name of their spouse, that would be a way to save taxes once they retire. Any questions on that? The other thing too to keep in mind is you can only contribute to an Rrsp till you're 71. So at 71, that window closes. So getting into some. Sorry, Todd?
We've got a question here. I haven't read it. I'll read it to you, Joel, if that's okay, so you don't have to look it up. So I'm an osteopathic practitioner. Initially, we were exempt from charging HST in September 2020. Our exemption was removed. I started collecting HST at that point. Now I'd like to understand input tax credits better. Can I use them for entire year or just portion of the year I was collecting HST?
Okay. I think my very next slide is on HST.
Okay. And then also curious about the quick method of calculation. And I presume, so this is going to be related to HST. So that if I use input tax credit, can I deduct HST as a biz expense? So I think that, okay, I think that we'll get to that. Yeah.
Yeah. So I'll just quick go over some programs that are available for business owners due to COVID-19. One is the SEBA loan. This was the one that first came out, it was $40,000. Now it's $60,000. That first $40,000 the government was giving out like candy. Everyone was getting one if they qualified. They're being a bit more stringent with the next 20,000. So please make sure you're reading the fine print before you sign anything for that next 20, because I think you do have to attest that either your income has gone down or your expenses have gone up. The CEWS subsidy, this is if your revenue has gone down, you can potentially get some of your wages reimbursed by the government. It is a fairly complex calculation. I have some clients that are doing it on their own. I have other clients that are coming to us to do it for them. The amount of money that I have seen going out the door for the CEWS subsidy is substantial. So if you have employees and your income has gone down, I highly recommend you look into the CEWS. Some periods have already closed, but there's still more coming up. The STRS subsidy is similar, except that it covers occupancy costs. I think that's the kind of the way I describe it. So if you're renting or you own a building or land, there are costs related to that you can then get covered by the government. So it'll be things like rent, mortgage interest, property taxes, insurance. So those are other things. It's another program that's out there. Once again, it's a more complex subsidy to calculate. So it could be something you do on your own. It could be something you need some help with. And then there was the TWS subsidy. That was the one that came out when COVID-19 first started. If you are filing your own payroll and you did not claim that subsidy, it could be sitting as a refund with CRA and you are unaware that it exists. So that's something you should consider as well. And Todd already covered the RRF loan and the non-repayable support program when we first started, so I don't need to cover those ones again. I think that the big difference with the RRF loan and the CEBA loan is the RRF loan is being run out of Middlesex County, so it's local. And there's someone you can talk to and kind of get it figured out. Whereas the CEBA loan, you are a cog in the machine and it's a government program. So there is a slight difference there.
As an accounting firm, Joel, and with these relief programs and these types of things, are you finding dealing with clients and trying to, obviously it's been for everyone to keep up pace on the different things and that type of thing, but has it created challenges for some of your clients in terms of their accounting, what they traditionally have done from an accounting perspective to?
Yeah, especially at first when they were changing the rules for these things every other day. Like I was often telling clients, what I'm telling you right now could be wrong tomorrow because they were changing the programs and the rules rather quickly. I know for a lot, we've had some clients who were basically making decisions on what to do in their business based on how much of these subsidies they would qualify for. Because if you were in construction and your job sites were getting shut down, you were basically sitting there going, how long do I keep my employees on the payroll? How much money can I get from these subsidies to keep people around? So and then there's also the tax implications of these subsidies because both the Qs and the Rrs subsidies are taxable. So you're getting in money from the government, but at some point you're going to have to pay a portion of it back. So, if you turned around and took all that money and immediately used it to cover costs, well, you're still going to have to pay the taxes on that at some point in the future. So there's short-term implications and there's long-term implications for all of these programs.
Well, I think that's a good analysis of, these things introduce some unique changes that you have to think about ahead, both in the short term and long term.
Yeah, and it's the same with the CERB, which was the $2,000 a month that people are getting. Just be aware that is taxable income. You will be receiving a tax slip in the mail if you did receive the CERB in 2020. Okay, COVID-19, everyone's an expert now. So then HST. So the first thing to consider is you have to register for HST if your income, the sales that you're having is taxable supply, when you have $30,000 in sales over 4 consecutive quarters, or you have $30,000 in sales in 1 quarter. Now, I'm giving you a very high level view of HST here. If you want to read up on you can get, as I said earlier, you can get lost in the weeds really quickly when it comes to HST. So this is a very high level view of HST. Once you register for HST, you are required to collect HST on all revenue that HST needs to be charged on. So the example I can give you is I had a client who was running a consulting business and he was charging HST on that. He also had a little landscaping business on the side. And he was working under the assumption that because his landscaping business was under $30,000 a year, that he did not need to collect HST on his landscaping. That is incorrect. If you are registered for HST under your personal name, you must collect HST on all sources of revenue for which HST is required. So if you have 5 different businesses going on, and each of them have revenue of $10,000, you are now over, $10,000 a year, you are now over that $30,000 number and you need to register for HST. Okay. Any HST that once you're registered, any HST that you pay can then be claimed back. So you buy a truck, that truck is a business asset, you can claim back the HST. Any day-to-day expenses, you pay the HST, you claim it. So basically, when you file your HST return, you show your revenue for the quarter, you show how much HST you've collected, you show how much HST you paid, and you pay the difference between what you collected and what you paid. So I highly recommend that you track your HST expense correctly, so that, because every dollar in HST you paid is going to reduce how much you have to remit to the government. And you have up to 4 years to claim any HST that you paid. So let's say you've filed your previous quarter, you're working on your next quarter, and you're sitting there going, oh shoot, I forgot to claim the HST on this one expense last quarter. Claim it in the current quarter. You have up to 4 years to claim it. So just because you missed it last quarter doesn't mean you've lost it forever. There's kind of 3 ways that people will file their HST returns. There's monthly, quarterly, and annual. Monthly, it's basically CRA comes in and says your revenue is way too high, we're making you do it monthly. Most people are not monthly. Most people are either quarterly or annual. The issue with annual is that if you are self-employed, your HST is either going to be owing at the end of March, or sometimes it's in June. I haven't quite figured out why CRA has different filing deadlines for different people. The issue with that is if it's March or June, that means your HST owing is going to come due at the same time you also owe your income taxes. So what I often see happen to people is they're running their business during the year, they're collecting HST, but they're not setting any of that HST aside because they're going to owe it at the end of the year. So then they come to me, I file their HST return, and we file their income tax return at the same time, and then say, okay, here is a great big bill that you now have to pay to CRA. And they sit there going, I haven't set any money aside for this. So what CRA would prefer you do is you set up a savings account and you set money aside to pay your HST at the end of the year. Because in the eyes of CRA, you are holding that money in trust for them. So this is something that does not go away because they view it as their money. So they will come after you. There are a lot more HST auditors than there are income tax auditors that I have seen. So it is something that they will come after if you are not paying that money to them. Then there is the standard method versus the quick method. They call it the quick method, but it is not very quick. Basically, the standard method is this. You take the HST that you collected and you reduce it by the HST you paid, and you owe the difference. The quick method is basically you take your revenue, you times it by a certain percentage, which is, so HST in our area is 13%. The quick method is it varies from business to business. But let's say you just take your revenue, you times it by 6%, and you remit that. But the thing is you have to adjust it because there's certain expenses that do not qualify for the quick method. So if you buy any capital assets, that does not qualify for the quick method. You have to actually, you would use that at 100%. So I know in our firm, in my office, I know of one client that uses the quick method. Everyone else uses the standard method, just because you look at your invoice, you know what you collected, you know what you paid. So as long as you're recording it correctly, you should know what that number is, right? So you can use the quick method, but it's the word quick is deceiving. It's probably the best way of putting it. Did I answer all the questions related to that HST question, Todd?
Yeah, I think you did. We had one supplemental was what if someone doesn't charge you HST for their service, right? So I'm assuming you. Yeah.
Right. So whenever I hear of that situation, my first response is, that's not really your problem. Because what's going to happen? So let's say you buy a piece of equipment from somebody for $10,000, and you know that normally HST is charged on that, but you look at your invoice and there's no HST. So what's going to happen is if there's ever an HST audit, they're going to go back to the person that should have collected it. And one of two things is going to happen. One, you're going to get a letter in the mail from the person that sold it to you that says, please, please, pretty please, I should have charged you $1,300 in HST, but I didn't. Please give me the money. And it's going to be up to you whether you decide to give them the HST or not. If the other is CRA comes in and says, well, you should have charged HST, you didn't. So we're just going to say that the HST was included in that amount and you really sold it for $8,700 and here now we're taking the HST off the top. So short answer, if someone doesn't charge you HST, that's on them. It's not on you. Because if you turn around and try and claim the HST and they audit you, they're going to come in and say, why'd you claim HST on this purchase? There's nothing on the invoice that indicates that there's any HST. So don't make their problem your problem.
That's a good answer. The only other question I think that we've got here that hasn't been addressed, as I'm kind of trying to integrate these when at the appropriate time. So we've got, as a sole proprietor, can you apply, so this relates back to the wage subsidy or the subsidy programs, right, for COVID. Can you apply for a wage subsidy as a sole proprietor to pay yourself as an employee of your business? Do any of these apply to that lost income? So I'm assuming that this may not have qualified for the wage subsidies, and
right.
What's the alternatives?
If you're self-employed, you can't pay a wage to yourself because you're paying taxes on the profits. So there's really no, it's like taking money out of one pocket and just putting it into the other pocket, right? So CRA won't let you pay a wage to yourself if you're self-employed. You can pay a wage to yourself if you're incorporated, because in the eyes of CRA, the corporation and you are two separate legal entities. So you can pay a wage, but now for some of these subsidies, and this can get really complex really fast once we get into these subsidies, is that the wages kind of had to be paid ahead of time. So in some of these situations, if all of a sudden you're going to put your wife and your kids on the payroll because you think you're going to qualify for all these subsidies, CRA will probably frown on that. It's intended to cover wages that were kind of already in existence prior to COVID-19, so that you didn't lay people off because of the virus.
And not to go into great detail, but even for some of these, I know for I don't know what's the case for SEBA, but for Regional Relief and Recovery Fund, which is really intended for people that haven't qualified for other sources of support and that type of thing, that there is the possibility that if you lost income as a result of COVID, and they can show that and substantiated that from a sole proprietor standpoint, that there was a wage or a draw or whatever that no longer exists, that could be part of, I've seen that incorporated as a part of relief type funding, right?
Right, for like the non-deferrable.
Yeah.
I think for some of these COVID-19 programs, it's almost best to deal with it on a case-by-case basis.
Yeah.
Because there's no cookie cutter approach for these things. Everyone's business is different, and everyone's going to qualify for these things in different ways.
Yeah.
It's difficult for me to just kind of give a answer that will apply to every single person on this call.
Yeah. Good.
Bookkeep. I think, yeah, there were a couple of bookkeeping questions. I think this might be my last slide. Yeah, I think it is. So I often get asked, so I bought, let's say you're selling essential oils or something like that, and you buy a bunch and then you give a bunch of the product away as samples or as advertising or something like that. And people will often ask me, well, how do I write that off? And my response is, well, you wrote it off when you bought it, because now you've basically turned some cost of goods sold into advertising expense. What you can't do is you buy the product and then try and expense it again because you've given it away. You can only expense it once. And then I think we also had a question about So when I recorded my income, and then I get charged some credit card fees, so my deposits do not actually equal what's on my invoices. The way that you would record that in your books is you would have, on one side, you would have your income. So let's say you have $1,000 in income, but you only receive 990 because the credit card charged you $10. So you would have $990 going into your bank, and you would have $10 in credit card fee expense. So that's how it would match up to the same amount, if that makes sense. And I think that's kind of my last slide. The last are just kind of some places to find information. So are there any other questions?
Yeah, I think we've got one here. We'll ask the accountant to define the difference between the terms gross revenue and income.
So that was kind of getting into that. I know a bunch of people that got the Rrsp were getting caught up in that a while ago. So gross income is your total revenue. So if you had $50,000 in sales, that's your gross. Your net income is going to be, it's your profit. So it's your income after your expenses. So if you had $50,000 in sales, $30,000 in expenses, your net income is $20,000. So the difference between gross and net is you consider your expenses. Your HST is going to be collected on the gross. You're going to pay income taxes on your net.
Very good. And feel free, if you have a question at this point, to either put through voice or video if you want to ask any additional questions while we have Joel here. You're more than welcome to. This is a good point for it. I don't see any unaddressed questions in the chat function. That was good though. There's a lot of interaction in the chat, and hopefully we were able to. Joel is very good at trying to accommodate the questions throughout the presentation, and I want to thank Joel from turning. Oh, we got a question. This, wouldn't you know, as I turn the corner to close things out. Does a not-for-profit corporation have to file a tax return even if there is no tax consequence?
Yeah, so if you have a corporation, you're required to file a return every year, even if it's a nil return. You still need to file it. It's just that it's identical to if you have personal income taxes. You still are required to file a return each year. It's just that if you have a refund, chances are CRA is not going to, if you have a history of having refunds, CRA is not going to probably pursue you as much to file that return, because they get to keep your money if you don't file.
Yeah. Very good. So yeah, no, I'd like to thank Joel for participating in this, turning, it wasn't quite the 3 hours that it could have been, but I think it was you did a great job of giving kind of an overview and addressing questions that came in as a part of the presentation. I think there was a lot of takeaways that I know myself personally, I pick up on a few things that I wasn't quite familiar with and learned. I felt like I learned some new things here today. I guess one thing that we can be certain is you can try to avoid death, but you can never avoid taxes. Right? is my kind of general takeaway. You covered every potential avenue of being taxed. So thanks again, Joel, for your time.